Okay, we have Gaston or Caston with a question for us on the right investment strategy. If you're just tuning in, this is Josh Jalinski, the financial quarterback. We are live on YouTube. Go to youtube.com, type in, you get to see my ugly mug. Although last week someone said, ooh, you're very handsome. Call us 800-321-0710 with any listener question. Hey, buddies, this is a live, uncensored, unscripted radio show. And let's say you don't want a free review. Let's say you just want a discovery call. We are now offering 15-minute discovery calls. We get on the phone and you get off and you see if we're a fit. All you got to do is go to calendly.com, calendly.com/Jalinski, Jalinski, and you get a 15-minute consult at no charge. Also, the 45-minute ultimate financial game plan, which also goes for an hour because I love educating our listeners. And if you call us right now, you get the Income for Life blueprint at no charge. So that's a special. You know, eventually I have all these people tell me I get a charge for these 1 hours. So eventually, you know, people start charging for the 1 hours, I think. So, but we're free for now. So give us a call, 888-988-JOSH. We got Caston. Go ahead.
Hey, Josh.
So what?
I
can hear you. Go ahead.
Yeah, I just need to find out. I'm planning for retirement about another year or two. You know, I have some 401k on my job. I have another investment, but I was talking to an investment guy a couple of months ago, and he said whenever time I'm ready to draw some of those money, I have to pay tax on them. So I just need if you could give me some more input on that.
Well, that's an IRA or a 401k, and that's why in the first segment I was talking about what you can do to save money and have it be pulled out tax-free in retirement. So you could look at a Roth 401k, you could look at a Roth IRA where the money grows tax-deferred and you can pull it out tax-free. You just have to have it in there 5 years of growth.
Right.
So that's
but I have those money inside some of these investment companies for over, I would say maybe 10 years or something like that, and they're saying to me, you know, whenever time I'm ready, you know, to pull out that money, you know, I have to pay tax on it no matter what I do. So I just want to find out which the best route that I go that I could maybe make some changes in my investment.
Well, definitely, and it sounds like you need to be educated on the tax location.
Right.
So there's two, not secrets, but two things that must be in your financial life from a perspective of your savings. Number one is asset allocation. Do you have the right eggs in the right basket? So think of the eggs as your money,
right,
and the baskets are different asset classes.
Mm-hmm.
You would want someone like me, a financial advisor, to guide you into how to best construct a portfolio for you.
Mm-hmm.
And you can call me at 800-321-0710 for a listener call-in question, or 888-988-JOSH for the free review.
Okay.
So number one, asset allocation. How to put eggs in proper baskets.
Mm-hmm.
Most asset allocation strategies fail because they do not incorporate asset allocation strategies. You have the pie, which is just a bunch of different garbage thrown together, but it's not weighted properly, and you're missing out on maybe different asset classes. That's asset allocation. Then you have tax location. And the thing about tax location that is special is you get to see, well, which asset is the most tax efficient for retirement, and it depends on your tax bracket. You look at traditional 401ks and IRAs where you get the tax break now, and then that grows tax-free, and then you pull it out and you pay taxes when you retire. Then you have Roths, Roth IRAs, Roth 401ks, where the money grows tax-free, and then when you pull it out, you pay a hefty tax bill on that.
On that, okay.
So we talked about health savings accounts. That's triple tax-free. That's a great way to save money tax-free for healthcare expenses in retirement, and also healthcare expenses before. We talked about life insurance cash values, which grow tax advantaged. We talked about municipal bond income. So there are a whole host of options for you that we can go through with you.
Okay.
At 888-988-JOSH. Any other questions on that, Gaston?
No, that's about it. I will give you a call, and then, maybe we could set up some more time. We could talk somewhere on that.
Oh, fantastic. So you didn't know that when you sock money in a 401k, it's taxable on the way out when you retire?
No, I never know that.
Yeah, that. And here's the other thing. A lot of people have you doing that, and they're not talking with your accountant.
Right.
They're not looking at your future self. What advice do you have for your future self? It might be, or what advice does your future self have for you?
Mm-hmm.
Why the heck did you do all this 401k nonsense when there was a tax-free option? Maybe you didn't need the write-off that much. Depends on your income.
Mm-hmm.
So if you're in a low bracket now, a Roth is a great way to go. If you're in a high bracket now, high tax bracket, you might be in a higher one down the line.
Mm-hmm.
But a Roth may not be right for you if you need the deductions now.
Mm-hmm.
So, I don't know about you, I'm getting slammed in taxes, so I need the deductions.
Right.
So, but some people think they're being slammed in taxes and they're in a 12% bracket, which historically is low.
No, right.
So they should look at things like a 401k.
Mm-hmm.
So thank you so much for the call, Caston. Next, we're going to talk about SEP IRAs versus solo 401ks and which is right for you. First, what is a SEP IRA? A SEP stands for a simplified employee pension. And a lot of people don't know that if you're self-employed, you can do one, get a nice write-off. A SEP is a type of IRA. SEP IRA contributions are made only with employer contributions. No employee contributions are allowed. It is a solid option for those who are self-employed and don't have employees in the business, or only have a small number of employees, for whom they are comfortable making contributions. You must contribute the same percentage of compensation to your employees' accounts as you do for your own. So if you find if that is too expensive, then a SEP may not be right for you. You could do a 401k or something like that for your employees. Contributions to a SEP can be made up of 25% of compensation, including self-employment income, up to a maximum of $58,000 for 2021. Then you get an additional catch-up, so you can put in like $63,000 and not pay tax on that money for 2021. This percentage may be lower for a Schedule C taxpayer due to the way the calculation works. However, a SEP IRA can be open and funded up to the date that the business tax return is due, including extensions. Now, a lot of what we're covering can be confusing and maybe even intimidating to you. But I'm here to tell you we're going to simplify things for you with our Income for Life report. You can get that Income for Life report free when you schedule and keep your no obligation review. And it's not a report just like a carte blanche, general information. We're going to customize that report year by year for you and your own assets, for your financial security, and for the people you love and the causes you love. So call my office right now for a no obligation review. That's 888-988-JOSH, 888-988-5674. And let us be the financial quarterback for you and help you diversify your portfolio to achieve your goals. And we're going to talk more about the difference between a SEP and a solo when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.